All right, so welcome to Beyond the Guidelines. This is the podcast that takes you past the listings, past the programs, and the polished sales talk to reveal the real people shaping today's real estate world. Here we uncover the personal stories, struggles, and wins that define each guest, giving you a fresh human perspective on the business. I am Jason Maxam, and together we are on a mission to help you see the person behind the professional, because real estate just isn't about the deals, it's about connection. Ryan, what is happening, my friend?
Not much, man. Just trying to get through it, man. There's a lot of stuff going on in the world, and managing that and making sure we're sticking to the business and keeping clients and realtors happy.
Absolutely. And I think I wanted to really talk about something that is kind of a big deal, right? A really big deal, right?
I was going to say, you even said it like it, kind of a big deal.
Probably the biggest deal we've ever seen in the history of the universe, right? The big, beautiful bill, guys. If you haven't heard about it, it's probably one of the biggest, most beautiful bills, according to Donald Trump, that we've ever seen. A very, very controversial bill. And like any bill, we see, politicians going crazy. We see the left and the right, and there's a lot of things going on, and not to politicize this at all, but what we wanted to do is we wanted to break this down to see really how this affects real estate and the mortgage industry, because that's what we're about here. So wanted to break this down a little bit and go over the benefits and also the, maybe the downside of this bill. And so, Ryan, are you ready to go over this thing?
I think so. Yeah, I've got some of my information up. I'm not 100% versed on it, but I know you and I can hammer it out and get some information out that's important to understand for the market.
Well, I know you printed out all 2,847 pages and have gone through most of it, right?
Yeah, I'm at page 3. Yeah, it's really
yeah. All right. So, I mean, honestly, let's start out with this, man. So what is your personal take on the scale of the bill, right? It's a $3.4 trillion spending package, adds a lot of money supply to our economy. How do you think it's going to reshape, in general, the mortgage and housing sectors, in your opinion?
Obviously, there's quite a few different things that are involved with it, but just starting with the debt alone, it's an interesting take from an administration that has kind of said that they were taking the other route, with certain organizations that are in there cutting out different things and that kind of stuff. So it's an interesting direction, really, because they kind of have said, now we're going to save money later, but add debt now, and kind of utilizing that 3.4 as that debt. What that does for the housing market, I mean, ultimately, that the ugly word of inflation kind of comes back around. Like, are we looking at that again, which is bad for interest rates? But there's quite a bit of positive mortgage and housing information in there that got passed through that I think can help stimulate the environment that we've been in to really blossom into what we've been accustomed to seeing over the last 5 or 6 years.
Absolutely. So I'm going to read this to you. So the first thing I want to talk about is really the real estate market impacts. And so this bill basically increases the allocation of the low income housing tax credit of 9% by 12%, and it lowers the bond financing threshold for 4% projects from 50 to 25%. That's a lot of numbers. But the changes are basically aiming, what this says is to stimulate the development of affordable housing, potentially adding over 1 million rental units between 2026 and 2035. So do you think that these affordable housing incentives finally address the chronic housing shortage, let's say in like urban and suburban areas?
Yeah, I hope so. I mean, ultimately, I'm an investor myself, so saying that I want lower rents doesn't sound like it makes a whole lot of sense. But the market got really out of control, and we've never really reset that market. And the reason is because there isn't that many rentals out there. And this past April, we were trying to kind of find a renter for our personal rental property, and it took a long time. And I was kind of wondering why. And it's really because people just can't afford to live in our city. And that sucks, because ultimately what you're going to see is, if they're unable to afford to live in the city, you're going to lose your service people. You're going to lose your waitresses and waiters. We're already seeing an impact in that. And I think that's kind of nationwide in the bigger cities. You're seeing less people wanting to work those jobs. Obviously, along with the no tax on tips, that kind of brings back a little bit of that. It allows them to kind of have the ability to not have to pay those taxes on the majority of the money that they're making, which may help them, be able to afford more of those houses. I'm hoping it does kind of spur a rental market in a way of opening up just opportunities for some of those lower income, the people that need the lower level housing. Which I think is, you can't say that's a bad thing, right? Opening up affordability for people.
No, I don't. And, obviously, and just to remind our viewers, so you're in Florida, right? In Florida, you look at California, you look at New York, you look at, areas where you see a huge increase in prices a lot quicker than where I am in Alabama. So I do think that it's a benefit for folks to be able to have housing affordability because, let's face it, man, affordable housing is still a problem. Like it is a nationwide problem for most of the United States of America. So I do think that trying to help the lower income into houses is always going to be a good thing. So
yeah. The only thing that worries me about the approach of it really is, are we treating the symptom or are we treating the cause? And that's right. Where, we kind of run into that all over the place with government intervention, is they try to treat the symptom and it can sometimes make the cause worse because of that. So that's really the only hesitation I would have about that. Like, yes, you need the housing, but you also have to figure out how to control ownership cost, because if ownership cost is up, then they have to rent them for more to cover their cost. So there's kind of a, chicken and egg and cart before horse, or whatever cliche you want to use there, right? Whichever one.
Absolutely. All right. So some other homeowners incentives. So, we have the reinstatement of the mortgage insurance deduction, right? So that's a big win for buyers. So homeowners now can permanently deduct mortgage insurance premiums, providing an average tax break of $2,364. It says this benefit is particularly advantageous for first-time home buyers and those with smaller down payments. So how do you think this will impact first-time home buyer behavior?
Ultimately, I hope it just kind of spurs the opportunity for more first-time home buyers. Obviously, we're seeing that they've kind of been priced out in a way, and that's where we go back to symptom and cause. What are we really accomplishing with that? Because they have to be able to buy the house to get the tax deduction, and that's the difficult part. The other side of that is, are we really giving them a tax break if they're taking the standard deduction? Because I think a lot of the people that they're saying that could impact, if they're taking the standard deduction of, what is it, 25,000 now for a couple, it's tough to come up with $25,000 worth of things that you can write off your taxes. So is it impacting them or not? We'll kind of see how that plays out, but I'm hoping that it does spur a little bit more first-time home buyer movement. You and I, as a company, we've kind of founded ourselves on helping out the people that don't really understand the process. And that's, we've definitely noticed that we've working with a lot less first-time home buyers over the last couple of years because of the affordability issue. So hopefully it does kind of incentivize or at least help them on the backside.
Absolutely. And I'd add too, like these tax reforms, they could risk creating some regional market imbalances. So I don't know. We'll see how it plays out. But again, like, with anything, with taxes and changes and all these things going on, it's really hard to navigate through it. It's so much information, just trying to break down the housing and how it relates to the effects of housing and mortgages. Like that alone in itself is like a huge study guide that we're still trying to get through. So I agree with you there. All right. So let's talk about so now there's going to be an increase in state and local tax deduction cap. So this is what they call the SALT deduction cap. So the SALT deduction cap has been raised from $10,000 to $40,000 through 2030. So this change is expected to stimulate housing markets in high tax states like California and New York by reversing demand shift caused by prior SALT limits. What's your thoughts on that?
Kind of the same thing as the insurance piece, right? Like they got to be able to buy the house to get into that ability. But, I wouldn't say that in our area, we're probably not going to see much of an impact on that outside of the luxury market, right? Like the average home price here, median home price is just over 400,000 here. So, we're not seeing taxes in the, 15,000, 20,000 on those homes. Surprising areas that you may see a benefit is like Iowa. My mother-in-law lives in Iowa and her taxes are ridiculous on her property for just slightly above median level home. So that's someplace, it may actually surprise you on the locations that you'd be able to see a benefit from it. But ultimately that does add, I mentioned the $25,000 standard deduction. You may be able to add to that now with that as well. I think obviously tax deductions are generally not a bad thing for anybody. So I hope it's some
100% agree with that, man. 100% agree with that. Well, let's talk about people that already own homes, right? So with the mortgage interest deduction cap made permanent at $750,000, how should borrowers with high value loans approach refinancing and tax planning? And this is a question to someone like you that knows what they're talking about when it comes to refinancing homes.
Yeah. Ultimately, the mortgage interest deduction cap being at 750, I think is pretty awesome. If you're in that range, again, I'm not a tax professional, so while I have some expertise in the refinancing, I never swear to say good tax advice, right? But it does allow some certainty for them, right? Like it allows them to understand like what they're going to be able to deduct. That's hard to say when you got all the sounds there. So that's really what it would benefit, is allowing them to understand every year what they're going to be able to write off and deduct. Ultimately, I think that's great that they've finally set something permanently, right? Because year to year, we see so many changes, or every other year, even, where you're getting into the situation where you have no idea what you're going to be able to write off. So I think that just providing some stability for people to understand.
Yeah, I think the permanency of it is a great idea, because it does, like you said, it doesn't allow anyone to make those changes, and any deductions back to a buyer, in my opinion, is always good. I don't care how big their house is. I mean, that's just the reality of it, right? Less taxes means more growth for the economy, in my opinion.
Absolutely.
All right, so let's jump into real estate professionals and real estate investors, because a lot of our viewers are realtors or buy and sell houses. So there is a qualified business income deduction. Now, this is for pass-through entities. It's increased from 20% to 23%. So what it does is it benefits real estate professionals and investors by they're improving their after-tax cash flow. So in your opinion, what kind of strategic shift do you think would happen that would encourage real estate investors?
I mean, ultimately, like you mentioned, the more taxes that you don't have to pay, the more incentivized you are to follow through on something. So, mentioning those rental properties, creating 1 million rental properties over the next few years, this incentivizes people to go out and buy a rental property because they don't have as much cost that's there. Now, again, the qualifying business part of it is important, because what that does is it requires you to be an active owner, not a passive owner. So if you are an owner who is utilizing a property management company, generally you're not going to be able to get this deduction, right? What it does allow you is, if you are that person that owns that rental, and maybe you call it a short-term rental even, and you're active a certain amount of time in that business, you get to qualify for that business deduction, because you are technically then a real estate investor, or an active real estate investor. So it does, I think it benefits often the smaller level person who owns 1 or 2 investment properties versus the bigger companies that own a bunch of them, because they're not active in their business. And it's, you're out there slaving away, cutting the grass at your rental property, 70 days or whatever it is, you get to qualify for a little more tax break. And that, ultimately, I think it's going to only help that smaller investor.
Yeah, I agree. I think we'll see a surge in pass-through entities and more LLC formations for these small real estate investors because of these changes. So I think, a resurgence and maybe some more small businesses that can now afford to go into business by using that deduction. Even though it's not a huge deduction, it's still a 3% increase. And, with the amount of rent costs that there is today, it's really hard to make a deal work sometimes, because when you have a rate that's in the 7s, it doesn't always make a lot of sense to build a real estate portfolio if your cash flow is too small. So I think any increase in that deduction, I think, is good, not only for real estate investors, but also an increase in maybe some small business. All right. So the last thing I want to talk about with you is really the interest rates and the fiscal risk of what we're going to see from this big, beautiful bill. So, with this bill expected to increase the federal deficit deficit by, $3.4 trillion. It's so hard to even say that as it rolls out of your tongue.
It's not even a number. It
doesn't even make sense, man. But I mean, I think we touched on it a little bit, but how concerned should we be about long-term interest rate hikes after this?
Yeah, like we talked about, I think this administration may have shifted their gears towards mortgaging the future impact towards more of an immediate impact, which again, in this economy that we've seen, maybe that's better. Maybe it's something that does help us. Ultimately, I think we're kind of at that weird tipping point with interest rates, right? Like they can't push higher because nobody can afford to buy a house, but they can't push lower because it's going to impact the inflation aspect and people spending money and the numbers, right? The data points. So we'll kind of see, exactly what it says is going to happen unless some other crazy thing happens where a requirement is different. We could have this same conversation 5 years ago or 5 years and 4 months ago. And then a week later, the whole conversation changes. And so, ultimately, while the plans lay out what you're expecting to happen, it's still reality and things will change what's going to happen. So, ultimately something big changes, we may see a different direction. But ultimately, I think that this administration also wants to get interest rates down. And I know that with Mr. Pulte there with FHFA, just watching him interact with people on social media, I think that's really his drive, is to help people actually afford homes. And so that's where you see some of these things like cryptocurrencies being used as assets and that kind of stuff. So they're kind of pulling at both ends of the string, and we just don't know who's going to win the tug of war at this point.
Yeah. I don't think we'll have interest rate hikes. We're obviously in an environment where, the Federal Reserve is being encouraged to lower rates. And I think they should listen. And I know Donald Trump is not the best communicator when you call someone a moron and stupid, and things like that to Powell. I think there's a better way of messaging to him, but that's just the way he is, right? The reality is our interest rates have been high for probably longer than they should be, just based on the economic data that we have. The Federal Reserve is really the only entity right now that's saying that everything's fine. I think if you look at the data, you can see that we're not fine. I think we are, if we're not in a recession, we're probably going into one very, very soon. And I think with this elevated interest rate, it's just going to continue to hurt our economy and our GDP. So
yeah, I think the biggest thing that they're not, and that the Fed isn't really taking into account, is because housing is such a big part of these inflation numbers. And we're not seeing massive whole-scale pullbacks on pricing of housing because the people that are wanting to move or that are willing to move are these people that have bought with 5, 6, 7% interest rates because they already have them, right? You're not seeing the people that bought in 2021 selling as much because they have the lower rate and they don't want to move into that higher rate. So because the housing market is still high as well. So you have high rates, you have high purchase prices, goes back again to the affordability piece, but bringing that into inflation, it's such a huge piece of the inflation, and it's kind of like being misrepresented based off of who is actually doing the buying and selling, and it's only the people that are comfortable with the high prices and high rates. So if they would strip out housing, which ultimately I'm sure there's a number out there that does strip out the housing, but if we're able to strip out the housing at its core level, we'd be able to see that some of the other stuff is returning to normal. The inflation numbers are down, which would then incentivize the Fed to bring the rate down. You see that internationally, right? Like all of the other countries have done rate cuts except the US. And they did the one, whenever that was, a year and a half ago, before a big moment in time, or 6 months, 8 months ago now, before an election. So who knows what that is? Obviously, we don't want to go political on it, but who knows what that actually means for the environment?
Well, not to get political, but I do feel like it's a political stance, right? Because I know right before the previous administration left, they cut interest rates to appear that the economy was better. And now they're holding off. So, I don't know if that has to do with the political adversaries between Democrats and Republicans. The bottom line is it's hurting consumers, and consumers to me are more important than left and right. So in my opinion, if the Federal Reserve doesn't make a move soon, I think it's just going to hurt the economy further than it needs to. Yeah, I don't know, man. What else you got? There's so much information. There's so much information in this bill. It's just hard to kind of, dissect. I think we talked about tax credits. We talked about homeowners with the interest deductions. We talked about investors. We talked about realtors. We talked about the Federal Reserve. I mean, what else should we dig into in this big, fat, wonderful, beautiful bill that I've created? It's the biggest, it's the most beautiful, it's the best thing that's ever been created in the universe. What's your thoughts?
That's a clip.
What else you got?
Yeah. Ultimately, man, like we talked about, it's going to, hopefully enhance affordability, especially in those high tax states where people just literally can't buy houses. I mean, California, New York, some of Florida, you just can't go to some of these areas and walk in and buy a house unless you're, a high income earner. For the investor side, I think, it's great that the QBI deduction and, the low income housing tax credit, they present kind of opportunities for increased returns and portfolio diversification. Like we talked about, you're able to kind of utilize that as a way to get back into housing because, over the last year or so, you've watched, there's just not as many investors buying homes. And it's because of the affordability aspect, one, but two, it's too difficult to make for too thin of margins. It's too difficult to do. When you're only able to pull in a couple $100 a month over the top of your mortgage, we're seeing a lot of these DSCR loans come in where they're at 1.05, where they're $10 more than the actual mortgage payment. And as an investor, when I started real estate investing, I was looking for a 2%. Right.
Yep.
I was looking for a 2x on that because cash flow, you have to have the cash flow because when things go sideways, you got to have the money to pay for it. And so hopefully some of those tax deductions allow that cash flow to be incentivized and really kind of bring the housing market back to strength instead of this kind of wobbly, our price is going to fall or they're going to go up. Nobody wants to jump in because they think the rates are going to go down, but then the rates go up and it's just, everything's so uncertain. So hopefully it brings some certainty to the market to kind of bring those investors back. And, we talked about some of the negative stuff that brought this bill out or that came out of this bill, but some of this stimulus stuff, and I would argue a lot of the stimulus stuff can balance out that bad side of the debt because it's going to allow the individual to thrive a little bit better, kind of balancing it out and hopefully being able to control interest rates in a way that makes sense for people.
Yeah, I mean, listen, when you inject money into an economy, it's always going to be good. It does start, it does jumpstart certain things, but how much debt can we get into, man? That's the thing that just gets me. Now, the administration will say, well, with the tariff deals, we're going to offset that by more growth. They're going to use cryptocurrency and start taxing and regulating that. So I think there'll be some more money there. But all the tariffs are still kind of, still up in the air. The administration basically said, hey, we're going to have all these countries done by a certain time. Looks like we're slowly getting some things done, but it's definitely not as smooth as I think this administration anticipated. So, I guess time will tell how we're going to be able to deal with this additional debt. But with any administration, it's all talking points. At the end of the day, they're always kicking the can down the road. They're always adding, debt to our children, grandchildren, great grandchildren. I don't think there's really, in my opinion, it doesn't look to me anyway, that they really want to solve the issue. They want to have a good economy. So what's the best way to do that? How do you save a recession, right? You inject money, you print money, turn it into a printing machine. Adversely, though, I think that's why cryptocurrencies are making such a big move because you can't print Bitcoin. You can't print things like Ethereum, right? You can have a safe place to put your money and not worry about the government having to make those changes. So that's just my take on it.
Yeah, I'm excited to see what the stability kind of comes out with the cryptocurrency. Obviously, you and I are pretty well invested in figuring out how to, understand and navigate the environment. The other piece that I think has kind of slipped by while this big, beautiful bill was being passed was the reductions of the limits on banks of how much their ratios can be, right? So it allows them to lend out more money with a lower level of cash in the bank.
Yeah, fractional reserve banking. Absolutely.
It's an interesting concept of a way to print money without printing money, because you're creating this debt And ultimately, you know, we talk about solving the debt problem. I kind of struggle with that as a statement in general, because we've, like, since 1974, that's all has been, right? Like, the numbers have gotten to a point of being absolutely astronomical, but debt is how the entire American economy has run for 50 years.
Well, yeah,
And
once we got off the gold standard, debt became money. So that's a Robert Kiyosaki statement that actually holds true for me, right? Like, I want to, and there's a reason for that too, man. It's not just that debt is money, but also that debt is not taxable. So you can use that in two ways. And if you use debt properly, by the way, creativefirstmortgage.com, we have all the scoop on how that can happen. Shameless plug there. But if you use debt properly on an asset that someone else can pay that debt for you while getting a benefit on that interest, then you are using debt properly. The problem is that most people, right, what do they use debt for? They used to buy depreciating assets, credit cards, high interest credit cards, those sorts of things. And that is not the way to use debt. But yeah, that's a great point about debt. But okay, so you're saying that, Ryan, about debt, that you don't like that statement. So are you saying that the government does not want to take care of the debt issue?
I mean, arguably, that's the answer to every question of yes. Like, there's, over the last 6 administrations, have you looked? And again, people will argue in other directions because they have stats for whatever you want to throw out and against it, right? Like, you put out a statement like this on social media and somebody's going to have the opposite statement because they found information that lines up with what they want to say. My view on that would be answering it in a question of, do they want to solve it? Does it make sense for any nation to solve once you get into that level of debt? Is this an opportunity or a situation where it becomes, do you shift to a different monetary standard? Like, how deep is this, right? When we say 3.4 trillion, you and I don't conceptualize that number. When they say it on air, like, I'm watching somebody, I can't remember who exactly it was, but Schumer, I think, he was talking about how, like, well, they threw 50 million at it. That's a drop in the bucket. And we're like, what are you talking about? That's a huge number, right? But 50 million is no longer a huge number. So to me, it goes, is this amount of debt, in their eyes of people who have unlimited liquidity, is it even a big number to them? Like, what is the level of where it becomes unmanageable? Are we at that point? Does it shift to bankruptcy, as Elon Musk wants to push out? Where does it shift to? Is it even solvable? And that's, you know, my understanding of it isn't full enough to say it is solvable or it isn't solvable. But that's the unlimited question: is it ever solvable at the levels we're at now? And was it ever designed to be solvable? Or was it always designed to go in this direction?
Yeah, that's a great question, man. I think that the government, first of all, they don't really care because it's not their money. They don't care. It's not their money. And that's the reality of it. However, is there a moment where bankruptcy, not really an option when it comes to a government per se, but maybe there's a shift in how monetary policy has worked? And I think we're kind of alluding to the idea of maybe this is why cryptocurrency, now that there's some regulatory, you know, agencies that are classifying Bitcoin as commodities and XRP and those other coins, is there going to be a shift in how money is used? I think the answer is yes. I don't know if there's going to be a flip the switch kind of moment, but I do think that cryptocurrencies, stable coins, and those things are going to be used on an everyday basis for governments, businesses, and individuals across the world in real time going forward. How does that solve the debt, though? I don't really know.
Yeah, and like I said, I don't know if it has to be solved, because at some point, if you're not using, you know, you mentioned not bankruptcy isn't an option for a government. There are scenarios in localities that has been essentially the concept, right? Like Chicago, for an example. Did you know that they make $0 off of their parking throughout the entire city because they couldn't afford to build the platform? So they sold the platform to somebody who could come in and install all of the tax meters, and now they get $0 in revenue from any of their parking meters. So the parking meter is completely third party. So while bankruptcy isn't an option, at what point, you know, and maybe we've done this throughout the last 50 years, but like, at what point does it start getting siphoned off of, like, okay, we're going to take this because we can't afford to run it anymore and give it to somebody else who can afford to run it. You know, obviously, I think we could talk about this for forever because there's so many different directions that it could go. But it's definitely a topic that is expansive, and depending on which side of the aisle you sit on, you could answer both ways to each one. And maybe that's how the government wants it, is kind of having it be ambiguous and allowing them to do that. So,
well, maybe bankruptcy just means that the devaluation of the dollar goes away, or the dollar as the world reserve currency goes away. And that's maybe how stable coins can help implement and keep the dollar as something of value, but also limited to the amount of, I don't know. You know what? We're going to stop there because if we keep going, it's just going to go, we're going to go around in circles because we'll just start talking about our crypto portfolio.
Yeah. And we don't want to do
mortgages to close today. So I think we should end it there, man, unless you got anything else to add.
No, I don't think so. I think, obviously we covered some good topics there, and hopefully we can have some discussions. I mean, if you guys have anything to put in the comments, we're open to reply and kind of comment back and forth, and maybe even bring it into another episode that we do here. We're always open to having differing opinions with people and seeing all sides of every issue. So appreciate you kind of dropping in with us. And real estate agents, if you're open to a conversation about yourself, or maybe even something that's popular in the market right now, we're open to having a podcast discussion with you. Jason and I both host them weekly. We do at least one episode every week with a real estate agent. So if you're open to that and interested in jumping on with us, we're more than happy to have you. And all you got to do is comment below and we'll get with you.
All right, guys. So that wraps up our episode today. I hope you got some value and enjoyed it. Give us a like and a follow, and we will talk to you soon. Thanks, guys.